The basis didn't change, right? The basis didn't change. It's still $1 million. That doesn't change. The exclusion offsets about 500,000 of gain. So an easy way to calculate that is just to increase your basis as if it were 1.5 million, right? But you're right on the other parts of it, Dan. Like you're gonna pay off the debt, so you're debt free. Like the 10 million, of that, $1 million paid off the debt at closing. But your million is still over in the bank, your own personal bank account, right? So that's still sitting there. And the trust typically gets about 9 million at closing, minus some of the closing cost, right? And but if you start taking money out of that 9 million, it's going to be partial return of basis, partial gain, okay, partial interest, depending.
But that million that's in the HELOC isn't in the trust, right?
Right, it's complete tax-free. It's
so
good.
Within the trust, you don't have that million as a basis anymore. It's been taken out. It's all gain in the trust other than the exclusion. That's the point I'm making.
Yeah, I think I see what you're saying, and I think to make it
dollar basis,
yeah,
plus the 500,000, 121 exclusion, but you did a HELOC. You took the million out, and the purpose of doing it was to take that money from the basis because that's tax-free money. That's money you already put in, so you take it out.
Everybody, Brett Swarts with Dan Palmer, Capital Gains Tax Solutions. We're covering some of the most commonly asked questions and or just some strategy as it pertains to capital gains tax exit planning. In this video, we're going to be covering basically the cash out refi before sale starts and what you can do to take advantage of this. It's going to be kind of detailed process for this, but Dan, I want you to tee up the challenge, and maybe you can, talk about the deal story without using any of the clients' names, but just generally, like, what's the challenge? What are they trying to accomplish? And then we'll use some numbers here to break this down.
Yeah, oftentimes when we're getting ready to do a deal, people will find that they have a basis that greatly exceeds the debt on the property. And the way the Deferred Sales Trust works is all of the proceeds have to go into the trust. And so they and then when they pull it out, they're going to take the interest first, and then, every dollar that comes out after that is going to be partial principal, partial basis, and partial gain. And so the basis gets kind of washed into the whole account, and they want to access that before the sale. So maybe they want to buy a personal home, or they have some personal expenses and they don't want to pay taxes after it hits the trust to get that money out and buy the personal use item. And so we're trying to come up with a way for them to kind of access their adjusted basis before the sale happens.
Exactly. So let's use a scenario here. Let's just say you have a $10 million property. Let's put this in New York, New Jersey, Palo Alto, San Diego. It's highly appreciated. We'll use it, make it your primary home. Let's imagine your basis is $1 million. Your basis is $1 million, but you have no debt on it, okay? And you're looking at selling, and you're saying, okay, well, gosh, I'd like to access some of this cash, especially up into my basis. How can I do this? But also I want to be able to defer my tax. And so first thing to understand is that any debt in excess of adjusted basis is taxable, and we cannot defer that using the Deferred Sales Trust. It's actually taxed ordinary income tax. And so it's the highest tax rates as well. So you want to be aware of that. And so the rule is, if your debt at closing is equal to or below your adjusted basis, and then 100% of the funds go into the Deferred Sales Trust, you are essentially 100% capital gains tax deferred, okay? Now let's imagine $100 of debt is above your adjusted basis, then you'd be taxed on that $100, okay? So it doesn't disqualify you from the whole thing. One other thing I'll add as well is, to the extent you need or want money, the trust can pay you that, you just pay tax on it. And so if you say, hey, look, out of my $10 million sale, I actually want $2 million immediately at closing, that's fine. You'll just have, that payment made to you immediately, and you'll pay tax on that, right? So that's something to consider. You can do the trust all or in part. Okay, so those are the numbers, right? So again, $1 million basis, $10 million sales price, 0 debt, all right? And, we'll use California. California, on a primary home, it would be about 33%. okay? Because you don't have the 3.8 Obamacare additional tax. So you have federal 20, you have 13.3 for state of California, so it's about 33%. So on 10 million times 33%, that's
They're
three.
also going to get that 121 exclusion most likely for the individual or the couple, so their basis actually will be a little higher if it's a personal home.
That's a great point. That's a great point. Yeah. So let's imagine that we add that. So we'll say they're a married couple. So now we're at, instead of the basis being 1 million, the basis is now 1.5 million. Now this is a part that's a little bit technical, but I'll break it down here. Someone would say, well, does that mean I can get up to 1.5 million of debt and still be at my same basis? Technically, adjusted basis is not factoring in the 121 exclusion. Your adjusted basis is the cost of what you paid for the property plus improvements minus depreciation. On a primary home, there is no depreciation. So if I bought the house for $750,000 and I put a $250,000 pool and backyard and new roof in, then my actual adjusted basis is 1 million. Now the taxable gain can be excluded based upon the 121 exclusion if you lived the last 5 years in that property. But for our standpoint, what we're trying to figure out here is how much debt can you refi prior to the closing and still be within below the debt over the adjusted basis? And the answer is 1 million. Okay, so what can you do here? Okay, so you have all the time to be able to do this. Okay, meaning let's say at least 6 to 12 months before you're selling. What I would suggest is you find a good bank that you work with. They can do a HELOC. Either do a HELOC of up to $1 million. It's probably the easiest way. Or do a cash out refi. It's going to be probably more expensive. Our encouragement would look for a HELOC, okay? So you would do a HELOC of $1 million. Now that cash is in the bank, okay? Now let's say you list the property 30 days later or whatever. Fast forward, you sell it for $10 million. That debt of $1 million is paid off. $9 million minus the closing costs hits the trust. Guess what? That $1 million that you did a HELOC on, there's no tax on that because it was less than or equal to your adjusted basis. I'm gonna pause there.
The fact pattern for them at that point is they're going to have the $10 million sales price. They're going to have a $500,000 basis from the 121 exclusion because they used the other million that they had, and zero debt. So that's going to be the new fact pattern after they do the HELOC or the cash out refi. $10 million sales price.
Yes.
$500,000 basis from the 121 exclusion, zero debt because that million now has been taken out, and when they sell it again, they're going to only have that $500,000 basis.
Okay, so let's clarify. So the basis didn't change, right? The basis didn't change. It's still $1 million. That doesn't change. The exclusion offsets about 500,000 of gain. So an easy way to calculate that is just to increase your basis as if it were 1.5 million, right? But you're right on the other parts of it, Dan. Like you're going to pay off the debt, so you're debt free. The 10 million, of that, $1 million paid off the debt at closing. But your $1 million is still over in the bank, your own personal bank account, right? So that's still sitting there, and the trust typically gets about 9 million at closing, minus some of the closing cost, right? And but if you start taking money out of that 9 million, it's going to be partial return of basis, partial gain, okay, partial interest, depending.
But that million that's in the HELOC isn't in the trust, right?
Right, it's complete tax-free. It's good.
So within the trust, you don't have that million as a basis anymore. It's been taken out. It's all gain in the trust other than the exclusion. That's the point I'm making.
Yeah, I think I see what you're saying, and I think to not
You have
to
a
make it
$1 million basis plus the 500,000 121 exclusion, but you did a HELOC. You took the million out, and the purpose of doing it was to take that money from the basis because that's tax-free money. That's money you already put in. So you take it out. It's no longer in there. When the money hits the trust, everything in the trust now is gain, except for that $500,000 exclusion. So down the road,
I think we're saying in two different ways. But let me break it down. What would my tax be if you take any of the 9 million? Let's just put it that way, right? So let's say I start taking $1 million of the 9 million, right? Of the 9 million, I take $1 million immediately, right? Well, how would I calculate my gain? Well, I take 9 million basically minus by the 1.5 million, which is like a $7.5 million gain of 33%, I would estimate $2.475 million. Now check with your CPA, okay, on
I don't
this.
think that's right, Brett,
Yeah.
because because you're double counting the $1 million that they took. So if they got taxed before the sale, you do the 10 million minus the $1 million of the basis. If they didn't do the HELOC, if they didn't do the cash out refi, the full 10 million would go in and they'd have a $1.5 million basis. If they do the HELOC, 9 million's going to go in, but they only have a $500,000 basis because that million's outside the trust in HELOC.
I think you're wrong. I don't think the basis changes just because you take cash out. So whether I take 5
cash
million,
out you're taking is the basis, right?
so
That's why you can take it tax free, right? Because now they can spend that money and not pay tax on it because it's the basis. It's
I think the difference is 10 million minus 1.5 million or 9 million minus 1.5 million. So it's a good question. We'll come back and we'll find out.
I just don't see how they can take the basis out and then count it again inside the trust. Like that basis is in the trust. It's not in the trust. They took it out and they're spending it.
Yeah, I don't. So here's the question. Yeah, one of us is right. One of us is wrong. We'll figure it out.
I'm normally right, so I'm saying I'm right.
We'll find out. My instinct on this is that debt does not change your basis, or so whether I had 9 million of debt at closing or 1 million of debt at closing, like my basis doesn't change based upon the debt that I have. My tax situation does.
But
And regardless if taking out doesn't also like my debt, I could have done a cash out refi 5 years ago, 30 days ago. Like taking cash out doesn't change the nature of the basis. Basis is this.
Can I ask you a question though? Because maybe this is where I'm confused and you're right.
Yeah.
You're taking that million out. The whole purpose is to take it out before the trust is formed, because then you can access that basis. So now that $1 million is out. Then you form the trust and 9 million instead of 10 million is going in because you've taken that million out, right?
Yeah, so when you say take out, so debt is basically secured against a collateral of a property, right?
Yeah.
So the property, so when I, like a stock is an example, right? Or any asset that I have, the collateral is they will take that if you don't pay the debt service. So I think taking out is probably an incorrect way to think about it. I think you want to think about it like the definition of adjusted basis or basis is cost plus improvements minus depreciation. That is the definition.
Let me ask this question. They do the HELOC or the cash out refi. Can they spend that money on anything?
Yeah, that's the cool part. So the cash out refi up into your basis, there's no tax. You can spend it on whatever you want. Correct.
So now you take that out, and you spend it. Mm-hmm. Before the Deferred Sales Trust has even been formed, the money's out, it's getting spent.
Yep.
So now you do the sale, it's still 10 million, but now you don't have that $1 million basis anymore.
No, you don't have the $1 million of equity anymore. You only have 9 million of equity.
Right.
Equity is different than basis.
Right. Mm-hmm. But the sales price is still going to be 10 million.
Yep. The cash from the buyer or the loan that's coming is 10 million at closing. The $1 million of debt's going to be paid off plus closing costs.
The real difference is the taxable amount of that 10 million. That's where I'm getting held on. So if the basis is in there, the taxable amount is going to be $1 million less. If you take the million, the taxable amount of that 10 million, it's still 10 million, is going to be $1 million more. The taxable piece. It's going to be deferred in the trust, but that tax now is inside the trust, and when it gets unwound, you're going to pay it.
Yeah.
That's where I'm getting confused.
So I think we want to just break down what it would be, right? So let's do a couple scenarios to break down. Let's imagine there was no debt, no basis, $10 million gain. You take it all at closing. You're going to pay about in this scenario, you'd add the $500,000 exclusion. So you'd have, no one's buying a house for zero, so it's just kind of a hypothetical here. But that would be a $9.5 million gain total that you'd pay on tax. 33% is $3.135 million. Now another scenario, you do 10 million all into the trust. You have zero tax liability triggered at closing. You defer all of the tax, right? That's the next scenario. And then so adding the debt to this only changes the tax liability if the basis is not $1 million, right? But since the basis is $1 million, if you were to close it all into the trust without doing the cash out refi, then basically you're locking in the ratio of the basis. You're locking it in there, Dan.
Yeah.
And you're only going to get a percentage of it. Yeah, even the 1.5, by the way, because some people go, well, don't I get the $500,000 exclusion? Can I get that up front? Can I take that as my first return of 500? They think, well, that would make sense, but the laws say you got to do it in proportion to every dollar you get back, you'll get a return of basis.
Yeah, the way I think about it is each dollar in the example you're using is going to have 15 cents of basis. If you do the HELOC, each dollar in the trust is going to have 5 cents of basis.
Yeah, but it doesn't change. But this is why this is strategy, right? So the rules, how I understand them, the rules are, it doesn't matter if you have debt less than your adjusted basis. That's why you want to do the cash out refi. It doesn't, like, again, the definition of adjusted basis or basis is cost plus improvements minus depreciation. Debt has nothing to do with your adjusted basis. Zero. Cost of what you paid for it plus improvements minus depreciation.
So now you're saying you keep the 1.5 basis no matter what you do?
Yeah, because that is the cost plus improvements, no matter what the debt is. No matter what the debt is.
I'm wrong, because logically that doesn't make sense to me.
It's tax strategy, baby.
Yeah,
it's tax flow, tax strategy.
Yeah, logically that doesn't sound possible, but if that's the case, then
let's do it the other way. Let's say you did
everybody should be doing that then, because you're kind of double dipping. You're getting the benefit before close, and then you keep your basis.
And it's technically not double dipping, because you put your basis was $1 million, right? Like you like let's imagine your basis was $9 million, right? Like your basis was $9 million. Like you bought it for $9 million, you're selling it for $10 million, right? The gain is only $1 million. So why it wouldn't make sense to say you have to put all 10 million into the trust, right? When you're like, I paid 9 million for it, right? So in this scenario, Dan, you've already paid for the million. Like your basis is that. So what they're saying is we don't really care if you have cash of that. Now we care if you took cash above and beyond the adjusted basis, right? They care about that. So so that is how I understand it. We'll come back. We'll talk to the tax attorney. We'll clarify it. But remember what capital gain is. Capital gain is, sales price minus closing costs minus the adjusted basis. Again, nothing to do with debt. So whether I have 9 million of debt, 1 million of debt, my gain has nothing to do with my debt. Now, the treatment of the gain, whether it's ordinary income tax or capital gains tax, has to do with my adjusted basis versus my debt. That's different. But the actual gain is calculated sales price minus closing costs, and then minus the adjusted basis will equal my gain, right? And this is why we want to have this strategy and make sure you understand it.
So when they take that $1 million, they're just taking $1 million of debt. They're not
of their own money.
Basis.
Yeah. Of their own money, of their own asset.
But it's not qualified as you've basically taken your basis down to the debt level. It's just you just took debt. It has nothing to do with
taking.
The
yeah, taking is probably not the great way to think about it, right? So it's you're
accessing it, whatever.
Yeah, debt is you're getting this. The HELOC is like I'm securing, like a bank when they give you a loan on your house, they're not taking $1 million on your house. They are taking debt that's secured against the house that's still worth the 10 million, right? But they're not taking anything from the house. The house is still the house that's worth 10 million. They're just saying, if the house sells, we're gonna get paid our $1 million back, right? So a HELOC is just a loan from a bank that says, if you are to sell this, we have a lien, we have a position that we get that back first. Different than the tax rules, right? Tax rules are like, then back to everything we said again. So we will come back. This will be episode 1, but let's just play out this version for a second. So this version on my side here, we would say cash out refi up until your adjusted basis is tax-free money, which is great. At the closing, 100% of the debt is paid off. The remainder can go into the deferred sales trust. At this point, you can be 100% tax deferred, right? And on that, let's say it's $9 million as an example. Let's just say you average 8 or 9%. We'll use 8% net of fees. That could be $720,000 of cash flow per year. And if you live off of that, you just pay ordinary income tax. If you took more than that in a given year and there wasn't any interest that hasn't been paid out yet, you'll get a return of principal. That return of principal will be your CPA will help you with this. They'll say, okay, of that, this much was the basis and this much was the 121 exclusion, and the remainder is the principal capital gain tax rate. So it's a formula. Most clients, Dan, right, like we see, they like to just keep the cash flow. In fact, they're probably going to live off like 500,000 of that. They're not going to touch the full interest amount, and they just live off the cash flow for as long as they really want to, and just pay ordinary income tax.
I guess my big question is, why wouldn't everyone do that?
So here's what happens.
We
Most people don't
do this. Why wouldn't everyone just basically take the cash tax-free to their...
Here's what I've seen in practice. They don't do the planning. They don't have the advisors to help them through this. Same thing with like the debt over adjusted basis when we do the Delaware zero coupon deals. It's a partial 1031. They don't know how to do that. They don't even know that Delawares are available. They don't know that Delawares are available for 80% LTVs, right? They don't know. They just really don't know, and they don't have the team. They don't think through it. And then all of a sudden they're looking to sell their house and they have it listed, right? It's on the market. And here's the challenging part: when you have it listed, it's on the market. Banks aren't typically going to want to give you a loan on that, right? Not that it means they won't, but they're like, what are you doing here, right? Like, you're just going to, like, the banks typically are, not that they won't, but I just have seen they push back on people to say you're listing it. The cost and the complexity to get a cash out refi are more challenging. I think HELOCs are probably, that's why I'm going, that's probably the easiest route here. But you're right. If they have enough time, Dan, then they should do this. Yeah.
Yeah, I haven't seen it very much, which obviously, because I don't completely understand it, so I wouldn't feel comfortable promoting it to a client unless I completely understand it. But it seems like something that we would be encouraging people to do every time.
We do. And let me give you two scenarios. There's the primary home scenario. HELOCs are pretty decently easy to get if you have decent credit.
You're going to pay a higher interest rate, but the point is you're going to sell and pay that debt off.
You're going to pay it off in 30 or 60, 90 days. So it's worth it.
Yeah.
You're going to save on DST fees. You're going to have total freedom with the money. Like we encourage you to do that. The other one is a commercial property. Commercial properties are harder to cash out refis, Dan. Appraisals, like the time it takes, like you need to be aware of your adjusted basis for sure, right? And make sure you're not going above that. Now, if you go above it, the difference is just taxable. Like, doesn't mean it disqualifies all of it. So, but commercial properties are harder to get cash out refis. Primary homes, HELOCs are probably the easiest, lowest hanging fruit for cash out refis. Or that technically it's not a cash out refi, that's just a HELOC against it. So, okay. So how do we land that plane, Dan? What do you think?
I don't know. I'm still confused. So
good.
I don't understand it, which is why we wanted to have this conversation, but I don't have much more clarity now than before other than the gain has nothing to do with debt. So I need to wrap my mind around that and try to understand just functionally how this is working.
I would say read the definitions of gain, read the definitions of a basis and adjusted basis. If you just read the definitions, by default, debt has nothing to do with gain. Debt has nothing to do with adjusted basis. And therefore, it can have nothing to do with whether I cash out refi or not, except for to the extent I get taxed. Okay, how they treat that debt in the excess of adjusted basis. So that's kind of the things you study. But hey, I'm Brett Swarts. He's Dan Palmer. We're out of time. capitalgainstaxsolutions.com. Here's the key thing about this. Every deal is complex. Every deal takes time and energy to plan. If you're going to maximize your efficiency and your tax flow and your cash flow and your debt flow and your capital gains tax and estate tax planning. And so be early. Plan with us. We have no cost consultations as long as you have $1 million net proceeds, $1 million gain, big enough deal that you're working on. We want to help you. It could be a business. It could be a primary home. It could be real estate, commercial investment real estate. It could be Bitcoin. It could be stock. Just go to capitalgainstaxsolutions.com. Hey, we also wrote a book on it. It's called Building a Capital Gains Tax Exit Plan. And we want to help you build it. Again, go to capitalgainstaxsolutions.com. I'm Brett Swarts. He's Dan Palmer. We'll talk to you again soon. Bye-bye.